In this short video we're going to look at the basics of IAS 36, which covers impairments. So what are we going to cover? Well, first of all, we're going to define what's meant by an impaired asset. We're going to show how an impaired asset's value would be calculated, and in doing so we'll define the meaning of terms such as recoverable amount, fair value less costs, and value in use. We'll also talk about when checks for impairments should take place, as well as explain the effects of an impairment loss and the sorts of things that would be included in a set of financial statements. So we'll start by stating what an impaired asset is. Well, it's a non-current asset where the recoverable amount is less than the carrying amount. Now, the carrying amount may be a familiar term to you. This is the amount that the asset is recorded at in the books. So it's going to be the cost less the accumulated depreciation. And of course, if the asset has been impaired in the past, we would also deduct any previous impairment losses when calculating that carrying amount. The recoverable amount, well, this is the higher of two values. First of all, the fair value less any costs to sell the asset, and we'll compare that against the value of the asset in use. Right, so let's spend a little bit more time on that recoverable amount. As we said before, it's the higher of the fair value, less cost to sell, and the value in use. So let's have a look at those two terms in order. First of all, we'll look at fair value less costs to sell. Now, this is generally the market value less any selling costs that we would expect to incur in selling that asset. And the selling costs would include things such as legal costs, any transaction taxes, removal costs, things of this nature. It's costs that we would have to incur in selling that asset. Now, previously I said that it's generally market value less selling costs, but it doesn't necessarily have to be market value. Where we might have an asset where there is no ready market for the asset, then we would have to use some other method of establishing fair value. But in the vast majority of cases, market value is available. Our second term is the value in use, and this is an estimate of what value that asset has for the organisational company itself. And generally this is the amount that that asset helps generate or save the business over its lifetime. Now that we've established how we calculate recoverable amount and carrying amount, let's have a look at an illustration of how this works in practice. So we'll say a company owns a commercial property. It has a carrying value of 1.2 million. Its fair value less the costs to sell is estimated at 0.8 million, and its value in use is estimated to be 1 million. Well, we compare the carrying value of 1.2 million against the recoverable amount, and the recoverable amount is the higher of the fair value and the value in use. And we can see that the higher of those two numbers is the value in use of £1 million. So our carrying value of 1.2 million is compared against the recoverable amount of 1 million. And we can clearly see that the recoverable amount is less than the carrying value, so our asset, this commercial property, is an impaired asset. The property should be valued at £1 million in the accounts, and this fall in value of 200,000 should be treated as an impairment loss, and it should be recorded as a cost in the statement of profit and loss. But when do we check our assets for impairments? After all, a business, even a small business, might have hundreds of different assets, and it would be very burdensome if the company was expected to continually review them for impairments. Well, what we do is we check the following. First of all, we check for impairments where there is an indication that an asset has been impaired, and we'll look at what we mean by an indication in a minute or so. We will also check any goodwill in the accounts annually for impairments, and likewise for any intangible assets that have an indefinite useful life, we will also check annually for impairment. So we might be talking there about, let's say, a brand name that might be included in the company's accounts. Okay, so what sort of things do we class as an indication of an impairment? Well, there are several. If, for instance, an item has become obsolete or has been damaged, then this indicates that an impairment may have occurred. Similarly, large changes in the technology being used in an industry, or perhaps the marketplace. So, for instance, if there is a property crash, we'd also take into interest rates and changes to legislation. All of these could impair particular types of assets, so we'd watch out for those. We'd also take note of any large falls in the market value of an asset, as this might indicate that the fair value less cost to sell, or the value in use, might also have fallen. We'd also take note of any unexpected worsening of performance of an asset. So, for instance, if we would expect an asset to be producing, let's say, 50,000 units a month, and we note that it's only producing 25,000 units per month, that might indicate an impairment. Lastly, we'd also take into account any expected changes in planned usage or the disposal of the asset, as both of those could also indicate an impairment. Expected changes might have something to tell us about the value in use, for example. Now, when an asset has been impaired, it is going to affect the calculation of the depreciation on that asset. When it's been impaired, we'll take into account the impairment loss, and we'll also re-estimate the asset's remaining useful life as well as any residual value. Let's just illustrate this. So a business owns a machine, it's got a carrying value of £10,000, and it's been depreciated in the past on a straight line basis at £2,000 per year. But we've noticed that the machine has been impaired, and its recoverable amount has now been estimated at £6,000. We've also think that we'll use it for another 2 years, and it's got a residual value of 3,000. So what we'll do is we will record an impairment loss of 4,000, which is the difference between the carrying value of 10,000 and the recoverable amount of 6,000. And we'll also recalculate all of our future depreciation charges. And this is to take into account the impairment and our estimates for the remaining useful life and residual value. Now, as we're doing this on a straight line basis, our annual depreciation charge will be changed to the £6,000 recoverable amount less the residual value of £3,000, and we'll divide that by the 2 years of life that we expect to use this machine for. So our annual depreciation charge would be changed to £1,500. Finally, we'll just mention what sort of information would go into the accounts. Well, we've already stated that any impairment losses would be recorded in the statement of profit and loss. But we'd also include an additional note to the accounts, providing some further information about any impairment losses. For each class of assets, so here we might be talking about plant and machinery, and then another class being freehold property, say. But for each class of asset, we would state the amount of the impairment losses that are included in the statement of profit and losses for the year, and we'd also say whereabouts in that statement of profit and loss those impairment losses are recorded. So we might say that they're included in the costs of sales line, or we might say administration costs, or one of the other lines where these things could be recorded. And that is a brief summary of impairment.